not locked in here with you. That's it! You're locked in here with me!
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whiteline. I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. So much interesting stuff, lots and lots, all kinds of things, stuff even. Interesting to the wide world of real estate. We will cover a bit today. It was really hard for me to figure out what I even wanted to title this show because there is so much I'd love to tell you. So maybe I need to spread it out over a few shows. But we have got all kinds of market things happening, all kinds of stuff in the offing here that I think are interesting to cover. For those of you who've been listening for a while, you know that I talk about identifying pivot points in markets, and I think we're likely in one. Now, of course, before we move on, let's talk about the various ways to get in touch. First, the website, therebelbroker.com. Head on over, click contact me, and you can do that. You can ask any questions, submit any suggestions, observations, questions that you might have. Happy to hear those from you. In addition, if you would like to join the Rebel Underground, and I know I haven't pushed this one in a while, you can text the number text the word Rebel Broker to the number 44222. That's text the word Rebel Broker, all one word, to the number 44222. You'll get automatically added to the Rebel Underground, and through the Rebel Underground, there will be access to exclusive materials that only folks in the underground get access to. You'll also get any newsletter type stuff I send out. And for those of you who hate getting onto these lists where you get tons of junk all the time, I think everyone who's currently a member of the underground may wonder if they are, because I simply don't hit you a lot with random bull. It tends to be only when there's something valuable to offer. My goal is to make more use of that to communicate with you all as we move forward. So if you'd like to join in on that, just text the word Rebel Broker to 44222. And of course, the website's always a great place to either consume the show, comment on the show, whatever. So feel free to take advantage of any of those means to reach out. Now, first on the hit parade is an article that I came across a while ago that was kind of a duh moment, right? Those of you who've listened to the show for a while may remember that when the small home movement really got going and everybody was singing its praises, everybody wants to live in a small home. And I was telling you, no, they don't. And it was something that if you know anything about human nature, you know that the vast majority of people out there in the world are not interested in tiny homes. There have always been a contingent of people who are sort of tiny home enthusiasts. There's never been a time when people haven't been sleeping in RVs out on the streets. The numbers may have varied depending on economic forces that might be at play, but there have always been folks who've been drawn to the smaller homes. Well, in an article earlier this month from Realtor Magazine, the trend now is for this to be less of a thing, and when it is a thing, for it to be as decked out as possible. To quote the article, buyers of tiny homes are increasingly favoring larger styles of the small dwellings, and they're opting for higher-end finishes that are moving overall costs higher. Some buyers want more space for their own enjoyment. Others are turning these tiny homes into vacation homes or renting them out for added income. And while that's only one small part of this article on the subject, in my experience, that is exactly what is happening. People are not happy in their small home, so they turn it into the thing that they'll use when they take a vacation, or they'll rent it out. And it's a moment for me to kind of say, I told you so. I had some folks who really wanted to invest in the tiny home thing, and unless you're strictly planning on making it a rental with the probability of higher turnover, in terms of you having to find new tenants more frequently. It just doesn't make a whole lot of sense. It goes on to talk about a few things here in terms of appointments, in terms of these things getting very much built up with stainless steel appliances, solar panels, built-in TVs, upgraded cabinetry. Some tiny homes traditionally are about 20 feet long and 8 feet wide. However, some companies are responding to buyers' desire for more space. The firm Cumming is showing off 30-foot plans, and the owner, Dan Lusch, says he's even getting requests for 40-foot models. So even in the tiny home movement, the folks who jumped into the tiny home thing are now saying, hey, you know what? Add 10 more feet to this house. So here's what we've done. From a housing standpoint, we are now slouching from the tiny home movement back into what mobile homes were, right? When they first started out, where you could get those smaller ones. I find it amusing and I find it obvious. And it amazes me that so much bandwidth was spent promoting how wonderful and great it was that so many people were so enamored with the tiny home movement, when it turns out it really wasn't a thing. And I'm glad that the folks who actually took my advice when they asked about smart investments or whatever, rejected it, because it's simply not the way to go, frankly, and it never was. Now, of course, if I was going to pick a story for a headline, it might be something along the lines of the softening market. Now, before we get too far into this, I want to make sure you understand that you need to understand how things are affected in your local markets. I, for one, have often shared stats from other cities because I consider them canary in the coal mine style cities. Now, one city that fits that bill for me locally is the city of Gilroy. When you start to see things softening in Gilroy, the outlying cities tend to get hit first, and Gilroy is kind of in that mode. In fact, projections are that for the first time in 7 years, Gilroy property values are going to go down more in the next. They're going to go down more in the next year than they've increased in the last year. That's an interesting stat. That feels like a pivot point. But let's talk for a minute about a community that's not nearby, but I think really is a good sample of a community that is sort of the poster child for this ramp up in the real estate market, and that's Seattle. Because the data there is super interesting. Let's go ahead and hit. Now, this is coming to us from realtybiznews.com. This article was out just a few weeks ago. Values have declined 4.5% over the last year, and Zillow predicts that they'll fall 3.8% within the next year. Now, what's interesting about that, remember when we talk about declining sales, right? In a lot of examples in the past, when we've tried to figure out which way the market was leaning, we understood we needed to get a bigger picture in terms of numbers. So if you're seeing the number of homes on the market going down at the same time you're seeing a decline in sales, that just kind of makes sense, right? If the market doesn't have enough product, well, then there's going to be fewer of that product getting sold. What I suggested from the very beginning is that you need to understand when the very first month that you see the stats that show there's now more homes on the market but fewer are selling, that's something you can identify as a pivot point. So we're going to go ahead and talk here about Seattle for a second, but I want you to think not, oh, this is happening in Seattle, I need to make decisions about my property if you're in Atlanta or Milwaukee or LA. No, what I'm saying is you need to take the logic that we're applying to Seattle and you need to apply it to your local market. And just like I use a local community here to sort of alert me to things that might impact my market more directly, I need you to do the same thing. I need you to not say I'm only going to pay attention to the data for the city in which I live. I don't think that helps you in making long-term plans. You absolutely want to track that stuff because you want real ground truth from right now. But what you also want to do is say, all right, here is the epicenter of where people want to be for whatever reason, because there's jobs or whatever it is that makes you, it's a downtown and people are drawn to downtown, whatever that might be. In my case, it's Silicon Valley, and Silicon Valley is to my north. What you want to do is draw a line from the center of what you see as the epicenter of hotness for real estate in your greater area, and I want you to draw a line to your community so that you're like the spoke of a wheel. The center of the wheel is hotness. Your community is wherever it is, then continue that line out to the next community. And I want you to keep an eye on communities further out on that wheel from the center, just as I've done, right? Because as you move south from San Jose, you hit my community of Morgan Hill. And then after Morgan Hill, you hit San Martin. And after San Martin, you hit Gilroy. So Gilroy is my community of choice. Why? There's a variety of reasons. The reason I skipped San Martin is a very specific kind of community. It tends to be larger lots. It tends to be multiple acres. It's a different makeup. Gilroy is a full-blown city. San Martin is more of a community that doesn't have a lot of home diversity in terms of what's there. So that's why. You want to apply that same logic to your situation. Okay, so why do we talk about Seattle? Because it's one of those cities that I think is informative on overall national trends. And if you start seeing things softening in some of these cities, it's important to look. I think Las Vegas is one. I think sometimes I think Miami is, sometimes I don't. I'm not really 100% sure. I think New York is one. I think areas of Silicon Valley are others. So apply this same logic to your local market. Okay. Prices are declining, and Seattle now has 2,370 more homes on the market than at the same point last year, an increase of 24%. Based on and this is again me quoting from the article, based on declining prices and increasing inventory, right? That's the dynamic. When those two things are going in those directions, that indicates a pivot point to me. Zillow now rates Seattle as a buyer's market, but buyers aren't in a hurry to lay down massive down payments just yet. Now, let's stop right there for a second and think about another element. Interest rates. Another thing on this show that I've been pushing is you stop paying attention to interest rates. Interest rates are nowhere near a place where it is the make or break decision on whether or not a buyer buys a house. It just isn't. Whenever interest rates happen to go up a point or a half a point or a quarter of a point at the same time that sales slumped, the very first thing headlines pointed out was, hey, interest rates are killing sales. Well, no, they're not, because the interest rates are still below 5%. I have not encountered a single buyer in the last year who said, hey, you know what? I really need to change my buying strategy because of interest rates. I need to not buy now because of interest rates. Never comes up. We are in a total ambivalent point on interest rates. And I think we have to hit some sort of psychological barrier relating to interest rates before people skitter one direction or another based on those numbers. And I think it's somewhere north of 5%. And we're not there. And now we're at what? When I checked interest rates, and I can check them right now. You know what? Let's be as topical. I'm going to head over to my favorite mortgage site, Mortgage News Daily. I am going to check the 30-year rate. The last time I checked, it was at 3.8. Let's see here. I'm sure this is compelling audio here as I sit here and wait for this website to load. All right, so for the 30-year fixed, today, June 27th, well, that's not today. Yesterday's numbers are what I have. Rates dropped 0.03, and they're at 3.82. That's not the lowest they've been over the last week or so. We've had it as low as 3.79, but these are sexy numbers. It wouldn't surprise me if they continue to go down. Your 10-year treasury is really what's more linked to these lending rates, and those are indicating that we're going to see a continuing drop in interest rates. Now, what's also interesting to note is that a year ago, interest rates were at 4.7. Sales were higher a year ago, with almost 1 point higher of interest rate in mortgages. So can we all please stop this goofy narrative that the reason why the number of homes selling or not getting sold is relating to interest rates? The only thing that is absolutely happening or not happening because of interest rates is refinances, right? Because that's all someone cares about primarily, unless they're trying to pull money out for some sort of other reason. Okay, so now that we've got that taken care of, let's cover some more numbers here as it relates to Seattle. Also, according to Zillow, the median home value in the Seattle-Tacoma Bellevue Metro is $490,300. That's a 1.2% increase over the past year. Where do you think the buyers are going? However, Zillow's forecast for these same areas is for a 0.3% price decline within the next year. Although these prices are more than $225,000 less than the core of Seattle, the close in suburbs still remain prohibitively expensive for most buyers. Either prices will have to continue decreasing or the outward sprawl will grow. So at this point, these guys seem to be looking at Seattle as stagnant or declining in the Seattle metro area. And they refer to this as contributing to a national trend. I also see this as a national trend. Some of our biggest metros are showing these kinds of trends. Later in the article, it states, quote, "It's entirely possible that Seattle's home price decline is an exception rather than a leader of a national trend, but there are other strong indicators." The National Association of Realtors reports the top 4 cooling markets compared to last February are San Jose, which is Silicon Valley just north of me, Portland, San Francisco, and Los Angeles. The overall housing supply in these major cities is up 40.2% year on year. We're seeing an increase in supply. Remember, that number is the supply number. And at the same time, we are seeing stagnating prices and declining sales. That is the equation we've been talking about. That is the supply going up, yet sales not going in the same direction. In past years, when we've looked at this data, when we've had people had the theory that things were recovering or we're seeing more homes going on the market, normally when we saw those increases in inventory, we also saw increases in sales. Now, another market we're going to take a look at here real quick is the Los Angeles market, sort of the general broad view. Again, it's one of those markets where I think checking out what's happening there is informative in terms of figuring out what a national trend might be. But before we do, we're going to take a quick break, so don't go away. We'll be right back after this. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Hello, everyone, and welcome back. I guess we could just call this reorienting ourselves to the market. Things are changing. I feel like we're in a pivot point here, and it makes sense for us to reassociate ourselves with these various markets. Now, we talked a little bit about Seattle before the break. I want to take a little bit of time now to talk about Los Angeles. Now, probably not today's show, but my next show, I'm going to pull out the big guns. As you know, I'm a real estate broker in the state of California in Morgan Hill, which is just south of Silicon Valley. And what I want to do is leverage off of my access to the very best data for Silicon Valley and really dig deep and see where we're at. So look forward to that show coming up here soon. But for right now, let's take a look at Los Angeles. Now, the article we're going to look at for today comes to us from Los Angeles Times and gives us some really good numbers here. Now, the Southern California median home price barely budged in May, according to the article. And according to them, a sign that the housing market is soft despite drops in borrowing costs. I suppose that's a rational way to put it, but let's just stop talking about financing costs, right? The costs of borrowing are so low that, in all honesty, I just don't think that it concerns people at all. So, as I said before, not a concern. Wait till the numbers get someplace where it should be a concern before we start even giving it any weight in this equation. Okay. So the 6-county median, there's 6 counties in the greater LA area. The point where half the homes sold for more and half for less rose just 0.2% from May of 2018 to reach $530,000, according to a report released Wednesday by CoreLogic. Sales dropped by 2.7% from a year earlier. Now, in addition to that, what we have in terms of numbers is California unemployment rate in May clocked in nearly record low 4.2. Employers added 282,000 jobs. That's all great. But the other thing we need to have in terms of making a smart decision here is inventory numbers. Now, at the same time, in May, there was nearly a 12% increase in homes than the year earlier. So again, same dynamic. And my argument would be that this is a formula you can apply to everything, right? If you've got increasing inventory, decreasing prices, or decreasing sales, there's something else going on here. And that is simply the supply and demand equation. That equals eventually lower prices. Now, remember, there's a psychological element to this. It's not an immediate response. What happens is over some period of time, sellers are going to realize my home is not selling. And they can ping their real estate person and say, hey, we need to do more advertising. We need to get more eyeballs on this thing. And that's a thing. I find myself in that position right now with a listing that I have where I'm doing everything I can to get more eyeballs on the property. I'm returning to strategies that I haven't had to use in a long time because of how strong the market is. We can actually have a conversation about that as well if you ever want to talk about those things. But anyway, the bottom line here is the one thing you control is that asking price. So as folks, now there's some folks who this is discretionary, right? They simply saw prices go to a certain point that it made it worth their time to consider jumping ship. So they're doing it. Others, it's not. They have a job they have to relocate to, or they have other financial issues in play that make a sale mandatory. Those folks are going to have to drop their price in order to get these things sold. And that's what we're seeing in a market like Los Angeles. According to the article, to close a deal, more sellers are trimming asking prices or paying for repairs. According to one agent in the San Fernando Valley, in May, 14.5% of listings in LA County had at least one price reduction, up from 11.9% a year earlier, according to Zillow. The shift toward more of a buyer's market can be seen in each county, where the median once consistently rose by more than 5%. Now, anecdotally, let me just interject here. A lot of you know that I use a variety of different tools to sort of keep my finger on the pulse of what's going on in my markets. Now, obviously, I can use my magical access to the MLS system here to really get interesting data. I mean, I get daily data on what's happening in the market in Morgan Hill, in other areas that I work with in San Jose. For instance, I love the southern San Jose area, the Blossom Valley area. There's different segments of the market I enjoy, so I keep up to date on. So I get a email telling me when prices are dropped. I get all of this data. So what's interesting to note is I'm seeing a lot of price drops on homes over the 1.2 million mark. So I'm not seeing it so much once you're down around 1.1, 1,999,000. Those homes are tending to still go at a pretty good clip, or at least going for that asking price. But just in the last week, again, I've seen 4 or 5 different properties in the Santa Clara, Sunnyvale area that have dropped, in some cases, $100,000, their asking price. So things are absolutely softening in some of these markets that have historically been amazing markets. And remember, in past shows where we've had ranked communities in terms of crazy growth in prices, Sunnyvale, Santa Clara, these are cities that were absolutely in that mix. Okay, so for those of you who might be interested in the Southern California market, let me hit the county summaries here that they provide in this particular article. In Los Angeles County, the median price rose 1.7% from last year to $615,000, while sales fell 2.9%. In Orange County, the median fell 2.6% to $720,500, while sales fell 6%. Riverside County, the median rose 3.3% to $392,000, while sales climbed 1.6%. It's interesting here to note this also. If you look at these areas on a map, it's interesting to see the migration, right? Because this would indicate different levels of migration. While we see Orange County declining 2.6%, we see Riverside County increasing 1.6%. Really interesting to see how the ebb and flow of where people are going is. And then when you identify the differences between those areas, and oftentimes it's strictly going to be price, right? Folks are simply mindful of price or other things. If you know those markets, these can be great tools you can use. If you're someone who's in the LA market and you're looking for interesting markets to participate in, and I'll tell you, in terms of a diverse market, LA, the greater LA area, is a great one to at least study if you want to kind of hone your skills on this stuff. Okay, anyway, Riverside County, median rose 3.3%, 392,000, while sales climbed 1.6. San Bernardino County, the median rose 1.8% to 345,000, while sales fell 3.3%. In Ventura County, the median was flat at 590,000, while sales fell 5.6%. In San Diego County, the median was flat at $570,000, while sales fell 2.9%. And you look at all of these and you sort of aggregate them, and you get this feeling that, the things in general in the marketplace are softening. Some of these specific counties may present opportunities. So within any market that might be in a pivot, I think you can still find areas that make sense. But if you're looking for those trends, these clearly indicate that we've hit a point where things look like they're turning a corner. Now, before we move on, let's cover one more metro area, and that's New York. But this one gives us an interesting case of you need to dig deeper, right? And one thing I've always talked about, knowledge is power. Figuring things out is the way to go. Understanding your markets is the key to being able to use the information you can get from them effectively. Now, of course, that's absolutely true in any market, but we have a great example of it in the New York numbers. Now, let's just sort of hit the main points here. In 2019, prices are down 5% year over year. Sales in the first quarter were down 2.7% year over year, according to the research to a research firm. In 2006, home prices were up about 15% from year to year. Between 2009 and 2010, home prices in New York City declined more than 10%. The Hamptons have been affected. These are things going on in New York. And the headlines are simply things like New York City home prices plunge. Well, here's a thing where you need to understand where something unique to that marketplace is playing a part. And if you don't look into things a little bit more deeply, do a little bit more research, these are not going to become clear. Because in this case, according to this article, New York City real estate prices are plummeting since the implementation of the Tax Cuts and Jobs Act, which imposed a $10,000 cap on state and local tax deductions. According to an analysis from Deutsche Bank, Global Research, and StreetEasy, home prices in Manhattan are falling at the fastest rate since the financial crisis. So in this case, we could have multiple things at play. It could be just a legitimate market decline. And there's other things we've talked about in the past that sort of feed that. But it's also this fact that there's this tax thing that is preventing folks from being able to reap the full rewards of home ownership or property ownership. So that's obviously something you need to be aware of. Now, if you're an investor, I would hope you would do your due diligence and be aware of something like this before you'd ever invest there. But let's talk about one more. Let's talk about another market that's near and dear to my heart, and that is Hawaii. Hawaii is on the warpath to kill everybody who owns property in Hawaii that they rent. They just passed within the last week. The governor just signed, I think it was SB 28. I can't even remember what it was. But it basically screws everybody who currently has property. So if you don't live on the island and you own property and you're renting it, by August 1st, you shouldn't be advertising your property for rent anymore, because the Hawaii rental police are going to come and find you through your ad, and your ad will be a de facto admission of guilt that you're renting, and you're not allowed to rent. So I'm located in a building where we have what's called a non-compliance use applied to us. So my understanding is it will not affect us, those of us who own a unit in there that we're renting. However, a lot of folks are going to get hosed here. And even folks who do live in Hawaii, the rule actually goes so far as to say if you do live on the island, you have to live within a certain distance of the property. And it's not like a mile. It's like yards away from the house. And it's this idea that the rentals that are being made available are hurting the communities in which they are, which doesn't make a whole lot of sense to me. It brings in local money. I'm not real sure what the problem is. Maybe it's the tendency of maybe some folks to rent and party. But I'll tell you what, as some of you may know, I've had a rental in Hawaii now for 5 years that I rent as a vacation rental. Never once have I had a renter who caused any issues relating to making too much noise or causing a ruckus. Not once. So my anecdotal experience is that this is a load of crap. The real reason that I think it's happening in Hawaii is that the hotel industry, because this is not just individuals who are owners of property that are trying to get some income from it. It's also folks who run bed and breakfasts is another one that's being hit by this bill. And when you look at it, the clear indication seems to be that this is simply a way to reduce competition for the hotels, which have a huge lobby in Hawaii, spend a lot of money on being friendly with politicians at the expense of the little guys, the mom and pops who may own properties. So being aware of things like that before you buy into a market is super important. In Hawaii, it's a super big deal. So something to be aware of if you're someone looking to invest in Hawaii. I'm not sure how this shakes out, but I don't see it ending well. It reduces the choices from folks who want to go to Hawaii. It artificially inflates the costs of finding accommodations in Hawaii, because the only thing I think that keeps an awful lot of this stuff in check as it relates to hotels is what little competition that there is from other homes in the market being offered for vacationers. So keep your eye on that kind of stuff, particularly if you're in markets where tourism is the thing. Whenever you get, and this is something I've noticed in a variety of areas, if tourism is the primary draw for an area where you're looking to do an investment in a property, be aware of the friendliness of the local government to property owners who are not also residents. You may find that it's hostile and may add complications to your ownership and to your ability to enjoy the rewards of the property. So just something to keep in mind. All right, folks. Absolutely appreciate you taking the time to listen to what I have to say on these subjects. The goal of every show is to leave far more knowledge on the table than you've invested in time. As always, hope we have achieved that today. And of course, the best way to reach out is through the website, therebelbroker.com. Thanks again for listening. I'll talk to y'all next time.